Car dealerships have played the same game for years, marking up prices, stuffing contracts with hidden fees, and pushing junk add-ons that nobody asked for. But things have changed. Inventory's piling up and prices are crashing after years of overcharging. Today, we're breaking down how the car market is flipping on dealerships and why they're stuck with cars that they can't sell, starting with dealers drowning in inventory. Car dealerships thrive for years by marking up prices and selling cars at whatever price they wanted, but things have changed, especially for some dealerships. There's one in Texas, and their lot's packed with 2024 F-150s while the 2025 models are already piling in. Now, that's a major problem because the moment new models hit, last year's trucks lose value fast. Dealers can try to offer discounts, but with high prices and rising loan rates, buyers aren't biting. Some lots have it worse. There's one that's got 2023 Wranglers right next to 2024 and 2025 models. Despite being on the market for 2 years, most dealerships are only offering a $6,000 or $7,000 discount on these Wranglers. Now, buyers aren't stupid. Why would anybody pay close to full price for a 2-year-old model when a brand new one is just a couple $1,000s more? Nissan dealerships aren't faring any better. Even those that avoided price manipulation during the markup frenzy are now struggling with overflowing lots. The problem isn't just one brand, it's the entire industry. See, these dealers don't own their inventory outright. Every unsold car is racking up floor plan financing costs. Basically, interest on the cars that they haven't sold. So the longer they sit, the more these costs pile up, cutting into profits and forcing dealers into desperate discounts. Just a couple years ago, buyers could walk into a dealership, get approved with minimal hassle, and drive off with a brand new car, even if they couldn't really afford it. That's not really happening anymore. Today, banks are tightening their lending standards, making it harder for both customers and dealerships to get deals done. According to Edmunds, nearly 20% of car buyers are now stuck with $1,000 plus monthly payments, and the average borrower is $7,000 upside down on their car loan. Some owe $10,000, $20,000, or even $30,000 more than their car is actually worth. Now, what happens is this puts dealers in a bind. They depend on payment buyers who are more concerned with the monthly price than the overall cost. But sales teams started markups, they had warranties and add-ons, knowing banks would approve massive loans to cover everything, but lenders aren't playing along anymore. Banks are rejecting more applications, cutting back on financing, negative equity, and demanding larger down payments. Even buyers who want to trade in their car can't because they're too far underwater. With fewer approvals and stricter lending rules, dealerships are losing sales and fast. And if that wasn't bad enough, the used car market is about to crash too. Car buyers have finally had enough. Dealerships used to have all the power, forcing customers into overinflated loans, stacking on worthless add-ons, and marking up cars by thousands. But the tables have turned and buyers have started to walk away in record numbers. The problem is that cars have become way too overpriced, and banks aren't handing out easy loans anymore. Back in 2020, the average monthly car payment was around $575. Today, it's over $750, and for some, it's well past $1,000. According to Edmunds, nearly 19% of buyers are taking out car loans with payments over $1,000 a month. Now, that's a number that was practically unheard of just a couple of years ago. And it's not just high prices, because interest rates have also shot up, making financing a new car even harder. And now, buyers who financed overpriced vehicles in the last 2 years are now trapped in massive negative equity. The average trade-in is underwater by $7,000, and some buyers are carrying as much as $20,000 in negative equity. That means that they can't afford to trade in their current cars, let alone buy a new one. Even lease customers are stepping back. In 2021, leasing made up nearly 30% of all new car purchases. Now that number has dropped to below 20% as lease rates have gone through the roof. Dealerships are rushing because there are fewer qualified buyers and trade-ins are depreciating quickly. Some are flooding past customers with calls, reducing prices and offering unheard of incentives, but it might be too little too late. Buyers are just refusing to play the dealership's game altogether. Dealerships were already struggling to find buyers, but now they're struggling to get them approved loans for buying their cars. Banks and lenders used to hand out massive loans not too long ago, But now they've tightened their requirements, and after years of approving overpriced deals, they've decided that they're done taking risks. Auto loan delinquencies are climbing fast. According to the Federal Reserve Bank of New York, over 6.1% of car loans are now at least 90 days delinquent, which is the highest level since 2009. Subprime borrowers are feeling it the most, with repossessions on the rise as lenders crack down on people who are unable to pay off their loans. Even prime borrowers with decent credit are being forced to put more money down, accept shorter loan terms, or just walk away entirely. The shift is hitting dealerships hard. During the pandemic, buyers could roll negative equity from a previous car loan into a new one, no questions asked. That's not happening anymore. Lenders now require larger down payments, stricter income verification, and lower debt-to-income ratios. Some are even capping the amount of negative equity they'll finance, leaving thousands of buyers stuck in cars that they can't afford to trade in. Automakers have started to step in to save the situation, though. Ford Credit and GM Financial are offering special financing deals to keep sales moving, but it's not enough. Dealers are watching potential buyers walk in, get denied, and leave without a car. And with interest rates still hovering at record heights, there's no fixing the damage these dealers have done to themselves because of greed. Price cuts are everywhere, but buyers aren't rushing in. After years of inflated pricing, automakers and dealerships are finally slashing MSRPs, offering rebates, and throwing in incentives to clear out inventory. Take Ford, for example. The company has ramped up discounts on F-150s, with some dealerships offering over $10,000 off of certain trims. Jeep is facing the same issue with the Wrangler and Gladiator, where discounts of up to 15% aren't enough to move 2-year-old inventory still sitting on lots. Even Nissan, which has been one of the hardest hit brands, is cutting prices aggressively, yet the lots are fuller than ever. The issue is high interest rates have made even discounted cars too expensive. A $50,000 truck with a 7% interest rate still results in a brutal monthly payment. Buyers who stretched their budgets in 2021 and 2022 now have little room to upgrade, and lenders aren't approving risky deals. Meanwhile, used car values are crashing, putting even more pressure on dealerships. Many buyers who financed an overpriced car during the peak of the market are now buried in negative equity. That means fewer trade-ins, fewer approvals, and even more unsold cars piling up. Dealers are trying to get creative, with some offering 0% financing on slick models, while others are taking a loss just to move metal. But when buyers don't trust the prices, the damage is already done. 2 years ago, used cars were selling for more than new ones. Now the prices are falling fast and dealerships are stuck with overpriced inventory and are suffering. CarMax and Carvana built their businesses on flipping used cars for a premium, but now they're stuck with inventory they can't move without taking a loss. CarMax reported a huge decline in profit margins as wholesale values continue dropping, while Carvana has been offloading inventory at auctions just to avoid bigger losses. This situation is just as bad at traditional dealerships. Many dealers paid record high prices for used cars in 2021 and 2022, assuming values would stay strong. Instead, those same vehicles are now depreciating at record speed. A lightly used 2022 Ford F-150 that once sold for $60,000 is now struggling to fetch $40,000. Some Jeep Wranglers have lost over 20% of their value in the past year alone. Now, the biggest losers in all of this mess are buyers who financed the car at peak prices. Many are now so deep in negative equity that trading it for something else isn't even an option. This cycle is choking dealership sales, leaving lots overcrowded and forcing dealers to eat the losses. Even rental car companies, which once paid outrageous prices to restock their fleets, are dumping thousands of vehicles back into the market. With supply increasing and demand shrinking, used car prices are only going down, and that means even more financial pain ahead for dealerships. Walk onto a dealership lot right now and you'll notice something different. Salespeople are really eager to talk. The days of take it or leave it pricing are over, and now dealers are calling, emailing, and even begging customers to come in. Some have even resorted to old-school cold-calling tactics, trying to lure people who visited months ago. Buyers just aren't showing up like they used to. Between record-high interest rates and the inflated car prices of the past few years, fewer people can afford to take out a loan. Data from Cox Automotive shows that the average new car payment now hovers around $700 a month, with nearly 20% of buyers stuck with payments over $1,000. Nearly a quarter of all trade-ins in the second quarter came with negative equity. That means 24% of cars being traded in still had loans that exceeded their market value. Buyers are rolling over debt into new loans, but with high interest rates and inflated car prices, they're just digging a deeper hole. The Consumer Financial Protection Bureau warns that these underwater loans lead to bigger monthly payments and stretched out loan terms, making defaults and repossessions more likely. Now that's bad news for dealerships. With banks tightening their lending standards, fewer buyers can qualify for financing, and those who do aren't looking to take on even more debt. Dealers are scrambling to get buyers back on the lot. In December of 2024, the average discount per vehicle hit $3,400, which is a huge increase from 2023. Electric vehicles in particular are being pushed with low-interest financing, cashback deals, and cheap lease options to move excess inventory. But buyers are hesitant even with these incentives. Negative equity keeps piling up and consumer confidence is low. Dealers are being forced to offer more aggressive financing and rethink their sales strategies. With inventory piling up and buyers holding off, dealerships and automakers are pulling every trick in the book to move cars. Dealerships are scrambling to adapt as the automotive landscape shifts beneath their feet. The rise of EVs has changed everything, with global sales projected to surge by 1.7% in 2025, reaching 89.6 million units. This surge is driven by consumer demand for substantial options, stricter environmental regulations, and inflated gas prices. Traditional dealerships, accustomed to gasoline-powered inventories, now face the challenge of integrating EVs into their offerings. Consumers have also started to prefer online platforms, expecting seamless virtual tours, instant financing options, and doorstep deliveries. Dealerships that are slow to embrace this digital shift find themselves lagging behind more tech-friendly competitors. Even Ford, which dominated truck sales for decades, is dealing with record-high inventory, forcing dealers to stack discounts just to get buyers through the door. The damage from years of markups and inflated prices has backfired for all of these dealers, because people aren't in a rush to jump back into the market, especially with interest rates still sitting at 7% or higher for many borrowers. Nissan, Ford, and Stellantis are cutting production to avoid overloading dealers even more, while some luxury brands like Mercedes and BMW are now focusing on direct-to-consumer sales. At this point, dealerships are running out of options. If buyers don't start returning soon, expect even bigger price cuts and incentives in the coming months. And for the dealers who overplayed their hand, their only choice might be to finally accept lower profits or go out of business altogether. Inventory is overflowing, prices are dropping, and desperate dealers are doing everything they can to stay in business. Will dealers finally learn their lesson, or is this just the beginning of an even bigger collapse? Thanks for watching. Let us know what you think in the comments section down below. And don't forget to subscribe for more updates on the car market.